Hello everyone, welcome to QuintEdge. This is CA FRM Yash Jan, and we are starting with new series in which we will be discussing valuation. The first part of that particular series is related to methods of valuation. Before we start with the video, let us discuss what all we are going to cover in this series. First of all, what is valuation? We'll cover this in this particular series. Then, where do we use valuation and what are the common assumptions behind valuation? We try to cover this part in this particular video, and this is going to be the smallest video of all the upcoming videos. Then methods of valuation we'll discuss. Then there will be Excel exercises, in-depth Excel exercises for various valuation method, DCF, precedent transaction analysis and comparable company analysis. And then reason for errors in valuation, we'll discuss this in detail. And then in the end, we'll have, do we get same valuation or same value across all three methods? We are going to discuss this and how they are interconnected with each other. So it's going to be a series of roughly 15 to 20 hours. So let us start with the series. Okay. My first question is, what is valuation? When we discuss this in live class, when we are having this modeling course, many people come up with very different answers. So what is valuation? Someone will say what I think its value is, or someone will say the price that I am ready to pay, or someone will say it's very subjective thing, so it's very difficult to define. I'm asking you, what is valuation? Okay. Before you try to define valuation of whatever existing knowledge you have, basis that you have to tell me, can these assets be valued or not? Okay. So we have 10 assets over here. You have to simply tell me whether they can be valued or they cannot be valued. Okay. Gold. I can listen to your thoughts. Don't worry. Gold. Gold can be valued, sir. Okay. Silver. Silver can also be valued. Copper. Gold, silver can be valued, so copper could also be valued, sir. Crude. Crude oil, I mean to say. Crude. No, crude cannot be valued, sir. HDFC, the bank, HDFC. Yes, sir, this can definitely be valued. I have seen its shares trading. Paytm, like the Paytm company, right? It can be valued. Okay. Fixed deposit. Sir, fixed deposit, I give them money, they give me money with interest. So, yes, I think it could be valued, sir. Bond, like not the James Bond, bonds. So, bond can not be valued, sir. Loan cannot be valued, sir. Sir, I think bond can be valued. Okay. And then Bitcoin. Sir, Bitcoin, I'll say it cannot be valued. Okay. So, most of the candidates give answers around this range only. Okay. So, gold, they will say yes. Now, answer. I'll not give it to you directly. First of all, let's understand what is valuation. So, when you want to find out fair value of something, true worth of something, like when you will pay for that thing and you will not end up overpaying and you will not end up underpaying. Whatever amount that you are paying is valuation, to put it very simply, right? Just imagine this. And value is obviously subjective. I agree with this statement. Valuation is subjective because everyone have different utilities. I cannot dive into utility topic right now because we have limited time over these videos. But everyone have different utilities and value in general will differ. When we are managing a portfolio, when we are investing in securities, our utility is we want the maximum returns for the lowest risk. That is, we all are risk averse. And basis this, the entire valuation is based, right? So, the ultimate end goal of valuation is we want to compare price of an asset against the value. So, price will be compared with value. You might have heard this statement. Value is what you get. Price is what you pay. That means valuation is subjective. So if price that you have paid is more than value, that is the value that you are deriving is, let's say, of 2 rupees, but you have paid 5 rupees for it. So you had a bad deal, or it is overvalued. And if price is less and value is more, like you end up paying 10 rupees, but the value that you derive from it is worth 15. So you have made a good deal. What you did was you have purchased something at undervaluation. The particular thing was undervalued. When price is equals to value, we say it is fairly valued, fairly valued. So what we try to do is, any asset, we would try to calculate fair value. How much a rational investor, because we are dealing with companies over here, like in the entire valuation course, so how much a rational investor would be willing to pay. And this is the broader assumption that we follow in the entire finance. The investor is risk averse. That is, he wants highest return per unit of risk. If in case you want him to take extra risk, he will start demanding more, right? So the curve of this would look like this. The indifference curve will look like this. We cannot dive into details of this, but I guess you have a broader idea of what is valuation. Now, I'll give you some hints, okay? So, basic assumption behind doing all the valuation is market make mistakes. For individual securities, for individual units in the market can be wrong. This is the assumption. If in case everything is fairly valued, that is, market do not make mistake, it is very, very, very efficient that anything and everything that is trading in the market is fairly valued, then there is no sense of doing valuation. Why? Because everything is fairly valued, so they are not deviating away from their value. That is, they are not undervalued nor overvalued. So why I am doing this exercise? I am doing this exercise because I can find something worth rupees 20 and that is available in market at 10 rupees, and I can end up investing in that, and ultimately when market realize its mistake, that 10 again becomes 20 or maybe go beyond that. So my ultimate purpose is to make return, and I am assuming when I am valuing that market makes mistake. There will be underpriced securities, there will be overpriced securities. Individually markets can be wrong. Okay, so without the possibility of errors, this will be a futile exercise. So basic assumption behind any valuation method that we are going to learn in the course is market makes mistake. Now, let's discuss this part. When I asked you to try to calculate value of any asset. So as per modern finance, value of any asset is present value of its future expected cash flows. Okay, FECF, that's different than free cash flows. So when any asset is expected to generate any cash flow, then only it can be valued using the modern finance techniques that we have, DCF or maybe relative. It only makes sense, or this asset will be valuable only if it is expected to generate future cash flows. This is how we can value any asset. There is no other way. Like gold, contrary to usual belief, it is impossible to value gold. You don't know, like think about it, why you buy gold? You believe that I have ended up paying 50,000, there will be someone in future who will be ready to pay 55,000 or 60,000. Inherently, gold do not generate any cash flow. So as per modern finance technique, you cannot value gold. This might be coming as a bummer for many people, but you cannot value gold as per modern finance technique. What you are doing is you are just praying that someone else will come, and for him, gold should be worth 55,000. For me, it is worth 50,000. So you are going to make this capital gain. But think about it. If you keep gold in your locker for 20 years, 10 grams of gold, after 20 years, it's not going to become 11 or 12 grams of gold. It's going to remain the same. The price would have gone up, and there is a difference between price and value. We've already established it, right? Similarly, silver. Any asset that is expected to generate future cash flow, you calculate present value of those cash flows, that will be the value of that particular asset. Copper also cannot be valued. Crude also cannot be valued. Basically, all the commodities, these all are commodities. Crude is energy commodity. These are industrial metal. One is precious metal. They cannot be valued. They will trade in market. They'll have their own prices. They'll have their futures market. They'll have options on it. Everything is there. But using modern finance, you cannot value it. Now think about these companies. Let's say you have 100 shares of HDFC and it is there for next 20 years in your demat. At the back end, is HDFC going to generate something? The cash flows. Yes, it's going to function. It's going to generate profits. It's going to give dividends as well. So you can value these companies. HDFC, is it expected to generate future cash flow? You even don't need guarantee of future cash flow. If in case there is some expectation, you can value that company. Paytm, yes. Fixed deposit, yes. Fixed deposit is a loan for bank. When someone gives you loan or when you take a loan, you give cash flows to other person in the form of interest, right? So FD, bond, loans. Bond is also a loan for a corporate. So basically all of them can be valued. So yes, because these assets are expected to generate cash flow, they can be valued. Bitcoin, same logic. Bitcoin is kind of now commodity. It's not a store of value because it's very volatile. Whatever is preached on internet to you, Bitcoin is not a store of value, at least in its current form, right? Like just treat it just like commodity, a very rare commodity whose prices may go up because it's very rare. But what value it is, like, is it expected to generate any cash flows? No. But sir, I'll give my Bitcoin to some other exchange and they pay interest on it. Then you have converted it into loan. Your Bitcoin is now a loan. So in that case, I am agreeing loans can be valued, but not Bitcoin individually. Treat it like a commodity. Okay. Now let us move ahead. Now, like as a finance professional, why do we use valuation? There are multiple use cases, but these are the ones that are very frequent. Firstly, to make investment decision. If you are working in equity research, you'll do research about a company, you will project its cash flow, you will project how industry looks like, government regulations are in favor or not, and then you will decide whether you should be investing, you as in your client should be investing in the company or not. So basically, you'll give the current market price and target. In case current market price is less than target, then you will say, let's say target is 2000, market price is 1500, invest in that. That is buy. You will give a recommendation of buy. If current market price is more than target, like the price is 1500, but target, that is the fair value, target is always a fair value, that is as per the research. The fair value of this particular company is only 1300. So you will not say buy, you will rather say short, right? Then mergers and acquisition, because A company have to acquire B company. So how much to pay to B company? That is, you have to calculate that. So you have to value B company. That is how you will be using valuation. Then IPO pricing. So lots of IPOs are coming these days again, right? There was some period in which there were no IPOs in 2022. Now IPOs have started again. So when company have to issue shares, like 2-3 years back, there was IPO of Burger King. So Burger King offered that share at, I think, 80 rupees per share. So how you arrived at 80, right? So there is process, book building and all, but there is some basis to it. That is, you do IPO pricing by using valuation, and then restructuring. So when company is in lot of trouble or company want to change its capital structure, change the level of debt and equity, sometimes it have to issue more equity, or maybe sometimes it have to issue equity to repay the debt. At that time, you try to value the value of equity. You have to value the equity shares of the company. So at the time of restructuring also, even in cases of bankruptcy and all, you can do valuations. Okay, so now we can discuss 3 broad methodologies that we use to value any asset. One is relative valuation. This is valuation by comparison. This is valuation by comparison. Then we have intrinsic valuation, in which you try to understand the fundamentals of the company and then you try to forecast the future and then try to arrive at the value of the company. And then we have asset-based valuation. This serves as the base value. At least this should be the value of company. So this is just a check to see base value of the company. Okay. And this is used for the companies that are about to be liquidated, are in the bankruptcy proceeding, or maybe companies whose tangible assets, like they have mines, they have oil rigs. For these kind of companies, I can use asset-based valuation. These are the three methods. And going ahead, there will be Excel exercises, very detailed exercises on these valuation methods. Okay. Now, relative valuation and intrinsic valuation will be our major focus area. Now, we have to discuss the assumptions behind these. Firstly, relative valuation. The reason behind relative valuation is you are saying whatever is your competitor worth it, my value should be almost on similar lines, right? So what we do, we say market make mistake in valuing individual securities, but on an average it is correct. So first of all, the basic assumption behind relative valuation will be market on an average will be correct, right? But individually it can make mistakes. Like when market is saying TCS is worth rupees 3,400, market may be wrong. But when I take TCS, Wipro, Infosys, L&T Mindtree, HCL Technology, and then arrive at some average figure related to them, then I'll say this is fairly valued. Because what will happen? TCS can be overvalued, Wipro can be overvalued, Infi will be undervalued, then L&T Mindtree will be undervalued, another company may be fairly valued. So on an average, the valuation is correct. So individually markets will make mistake and can make mistake, but on an average markets will be always correct. Okay, so we are not contradicting with our previous statement. Then firstly, the first step is, the major assumption behind this is TCS, Infosys, Wipro, L&T Mindtree, all of them are comparable. So they are comparable in terms of their industry, size, growth prospects, and risk factors. I can say whatever risk TCS is facing, similar risk is faced by all its competitor, right? Their size is almost similar, size in terms of market cap or in terms of sales. Basically, if I want to compare myself, I'll compare someone with the boy or with someone who is having similar height, similar weight, similar stature, right? Same thing will apply over here. Like if someone, let's consider an example. I want to buy a flat 1,000 square feet in area in Delhi NCR region that have amenities of hospital should be nearby, there should be some school, market should be nearby, right? I'll go to a broker, and then what broker will do, he'll say, okay, there is a locality which satisfy all your requirements. In this particular locality, I've helped other clients to buy flats. Now, some flats were 800 square feet, some flats were 1200 square feet. So broker will tell me rate per square feet in this locality is, let's say, 10,000 rupees. Now you want to buy 1,000 square feet of flat. So fair value of your flat, or like on an average, you will be able to get flat at 1 crore rupees. 10,000 multiplied by 1,000, right? Same, this is relative valuation. Broker have compared the flat that I want to buy with other flats with the similar amenities that is there in the same locality. So market is nearby, hospital is nearby, and whatever facilities that I want. So they are very similar. And if they are similar, whatever were their value, similar should be my value. But I want 1,000 square feet flat. Other flat would be 800 square feet or 900 or 1200. So what I can do is calculate multiple, that is rate per square feet. So in relative valuation also, we work on multiples. We try to refine multiples as much as we can. But this is the basic assumption behind CAA, that is comparable company analysis, that all the competitors or all the transactions that I'll choose will be comparable to each other. Okay. Now, another assumption is, because I'm going to compare my flat with other flats. So the market should not be very volatile because one flat would have been sold last year. Till now, the market conditions can dramatically change. So another assumption is market condition, industry dynamics are relatively stable. They are not changing every other quarter. They are pretty much stable. So I can pick up transactions or the multiples that are very stable in nature. So the rate at which flat is sold is going to be similar to the rate at which I am going to buy, the rate per square feet, because nothing major have changed in that locality. So this is another assumption. Okay. Then we have DCF method, that is intrinsic valuation. In intrinsic valuation, there are not too many assumptions that we have to follow. This was valuation by comparison, the relative valuation. In DCF method, what we do is we ignore all the competitors and we say my valuation will be derived on the basis of my margins, my growth rate, my products, my capital structure, all these things. Like 1,000 square feet of flat, instead of saying these are the flats available in this locality and this should be this is the value of those flats, so that should be the value of X should be value of my flat. Instead of saying this, I am saying basis the construction quality, basis on which floor it is, basis what's the view outside, basis how many rooms it have, basis furniture that is being put in, I can arrive at the value, and that is also perfectly fine, right? So in DCF, what you do is you forecast how much cash flow a particular asset is going to generate. And when you are doing DCF, companies are said to have going concern, that is they will continue their operation for foreseeable future. So you can't keep on forecasting cash flows till infinity. So there are mathematical techniques using which we can calculate something called as terminal value. We'll discuss this later down the line. So what you do is you calculate present value of these cash flows and then you add up together. This becomes value of the particular company or value of equity, right? So this cash flow forecasting is very necessary, and the company will continue its operations for foreseeable future, for very long term. Otherwise, if the company is going to generate cash flows for next 2, 3, 4 years, firstly, you should not be investing in it. In case you want to invest in it, then simply calculate present value of these cash flows, add them together. The challenge lies in, because when we calculate DCF, let's say we arrive at value of 100. These cash flows will hardly give 10 to 20% of valuation. Out of 100, 20% of the value will be coming for next 3-5 years that I forecasted. Remaining 80% of the value will come from the period that I have not forecasted and where I am saying the business will keep on continuing. I can say what will happen in business next 2 year, 3 year, 4 year, 5 year. But what will happen 10 years, 20 years down the line, I can't predict, right? This is where terminal value as a number comes in. So we learn this in future. But DCF, the basic assumption is the company will continue its operation for foreseeable future, for long term. And I'll somehow calculate their present value using some mathematical technique, arithmetic geometric progression, and then I arrive at the value. Okay, this is DCF. Then the last one for this video, asset-based valuation. Asset-based valuation. In asset-based valuation, we use a very simple exercise. We have learned this in our 11-12 standard. If in case you have done like 11-12 from accounts or commerce, equity plus liability equals to assets. We just algebraically modify this equation and we say asset, this liability goes over here, asset minus liability will be equals to equity, right? And this can give us value of equity. So what we do is we say majority of the value of the company, like we will use this technique when majority of the value of the company is derived from its assets in place, the assets that it is already having, when most of the value is coming from that. And that generally happens with the companies that are having or that are into bankruptcy or that are about to be liquidated, number one. Or number two, these companies are into mining or maybe extraction of oil. So majority of their asset is the mines, the oil rigs, etc. So what we do is First, you'll try to value all these assets. What's the fair value, market value, realizable value of those assets, right? From these value of assets, we'll subtract all the liabilities, its creditors, its loans, its bonds, etc. And whatever is left belongs to equity. This will give us equity value, right? So this is asset-based valuation, easiest of all. So what we are going to do is, we'll stop for this video because it's already getting extended. So in next video, we'll have asset-based valuation, in which we'll try to value a company. First, we'll value, find out the net realizable value or market value of assets, and then we'll deduct the liabilities, and then we'll be able to arrive at fair value of equity using asset-based valuation. So let's pause for the video and we'll see you guys in the next one. Bye-bye.